All right, joining me now is Jason Pride, Chief of Investment Strategy and Research at Glenmede. So good to have you here with us, Jason. Thanks so much for joining the show. So I was
absolutely great to be on.
I was just talking about the red arrows to kick off the month of June, although already off levels that, the worst levels that looked like we could open. Easier to make the case that the market moves higher or lower from here?
First, thanks for having me on. It's absolutely a pleasure to be on with you guys. The market from here, I think, really has to kind of grapple with this kind of Jekyll and Hyde phenomenon in current policy, from the perspective of trade policy, which majority of economists and I think investors on the whole see as a tax on business that benefits the governments and effectively acts as at this point in time, about a 1 to 1.5% headwind to economic activity, but then offset by the other side of the equation, which is this fairly large spending bill that's working its way through Congress that we think could be front-end loaded on the first 4 years with a pretty significant offset to that trade policy impact that we were just talking about. And I think that balance of things, if it remains in balance, this is an economy and market that continue plodding ahead. But if that imbalance comes under question, if we think there's less coming from the bill, or if there's more trade tensions, we can easily see market weakness on that basis and uncertainty.
Jason, that's on the fundamental side. How are you thinking about valuations right now, though, given how much the market ran in May and how far we are from the lows?
Absolutely, Caroline. So generally speaking, equities on the whole are actually generally in the ballpark of fair value. They're a little bit above fair value, but not dramatically so. But then when you start dissecting it, you see kind of similar stories to what we were seeing at the tail end of last year. Large cap equities sit a little bit above their 75th percentile of valuations. The rest of the market, international, emerging markets, developed, smaller capitalization securities, all sit more close to fair value levels. So we've been recommending to investors that this is very much an environment where diversification of your portfolios is really important, getting away from, not necessarily eliminating, but moving away on margin from the largest, most overvalued issues within the US market, and favoring both international security and currency diversification, as well as capitalization diversification within portfolios.
Well, the fact that you favor U.S. small caps means that you must think that the economy is on pretty solid footing, no recession in your forecast?
At this point in time, we do have a likelihood of recession. We're marking that at about 30%, but not a 50% or greater chance of recession at this point in time. If that stays in place, smaller cap companies should do reasonably well. And generally, we're in an environment now where rates, we think, are stable and maybe coming down over time, particularly on the shorter end of the curve. And small cap securities are more exposed to rates. It's actually been their biggest headwind over the past, say, 12 to 24 months. And we think it is now basically a non-existent headwind, or one that will possibly turn into a modest tailwind to their earnings.
In terms of international diversification for at least the first several months of the year, I'm not sure how May ended up with the S&P 500 having such a strong performance, but international stocks had been outperforming U.S. stocks. Do you think that will continue to be the case, and that still looks attractively valued despite the run-up that we've seen?
They do still look attractively valued on the whole. Certain markets are more attractive than others. We would argue that Japan is more attractive than Europe. But additionally, this is very much about currency diversification. This is an environment where people are questioning, and I think a lot of international investors are questioning whether they want to have quite as much U.S. currency-based investments within their portfolios. And if that's occurring, on the margin, there's a move away from the dollar that should probably persist throughout 2025 and might actually be even a longer-term phenomenon than that. We don't mean that that's going to be like some huge wholesale sell-off in the dollar, but there could be a gradual kind of creep away from the dollar that occurs over a number of years.
Jason, you didn't mention big tech. I'm curious what your thoughts are on tech after earnings, and given the fact that although well off the lows, 4 of the Mag 7 are still in negative territory for 2025.
Big tech there's a fantastic growth opportunity within big tech. The question is how much are you paying up for it? Some of those securities are actually worth paying up for, and some of those are not. And we actually leave that to our underlying managers to pick through the individual securities and invest overweight or underweight those securities for us within large cap.
All right, Jason Pride, Chief of Investment Strategy and Research at Glenmede. Thank you so much for your sector picks and your insights.
Thank you, Caroline.
Have a good one.